Building $10,000 per month in passive income sounds like a dream number for many Americans, but the reality is far less glamorous than what social media usually shows. Passive income is not about quick wins, viral side hustles, or overnight success. It is about building income-producing assets that generate cash flow whether you work or not. In the United States, the most reliable passive income streams historically come from four major categories: dividend-paying investments, real estate income, digital or scalable businesses, and interest-producing financial assets. Each of these requires upfront capital, time, or skill development. The biggest mistake people make is focusing only on the monthly income goal instead of calculating the asset size required to generate that income sustainably. For example, earning $10,000 per month from investments alone often requires anywhere from $2 million to $4 million, depending on the yield, risk level, and tax structure. This is not meant to discourage investors. It's meant to ground expectations in financial reality, because understanding the math behind passive income is what separates real wealth builders from people chasing unrealistic promises. One of the most common and reliable passive income strategies in the US is dividend-focused investing through ETFs and high-quality dividend stocks. Dividend ETFs allow investors to earn regular income from companies that share profits with shareholders. These funds typically focus on financially stable businesses with strong cash flow and consistent dividend growth. Many investors underestimate the power of dividend reinvestment and compounding over time. For example, someone building a dividend portfolio that averages a 3% to 4% yield would need roughly $3 million invested to consistently produce around $10,000 per month before taxes. While that number sounds large, long-term investing through consistent contributions, reinvested dividends, and market growth has historically allowed disciplined investors to reach these levels over time. The advantage of dividend ETFs is diversification, tax efficiency, and reduced company-specific risk, which makes them attractive for investors focused on predictable cash flow rather than aggressive growth speculation. Another powerful passive income method widely used in the US is rental real estate investing. Real estate generates income through tenant rent payments, while also providing potential appreciation and tax benefits. Investors can purchase single-family rental properties, multifamily housing, or invest through real estate investment trusts, also known as REITs, which allow individuals to earn rental income exposure without directly managing property. Real estate income can often scale faster than dividend investing because of leverage, where investors use financing to control larger assets with less upfront capital. However, leverage increases risk, especially during economic downturns or housing market slowdowns. Successful real estate investors focus heavily on location quality, rental demand stability, cash flow margins, and property management efficiency. Many investors reaching $10,000 per month in rental income typically own multiple properties or invest in higher-yield commercial or multifamily real estate portfolios. Digital assets and scalable online businesses are another growing passive income category in the U.S. economy. Unlike traditional investments, digital income streams often require more upfront effort, but can scale dramatically once systems are built. This includes YouTube channels, affiliate marketing websites, SaaS software businesses, online courses, and digital product sales. These income sources are often called semi-passive because they require initial content creation, marketing, or technical development before they begin generating recurring revenue. However, once traffic, audience, or subscriptions grow, these digital assets can produce income with relatively low maintenance compared to traditional businesses. Many modern entrepreneurs reach five-figure monthly passive income levels through digital ecosystems where content, automation, and recurring subscriptions combine to create predictable cash flow. The biggest advantage of digital passive income is scalability, but the biggest challenge is competition and the time required to build authority and audience trust. Another overlooked but important passive income source for U.S. investors is interest-based income from bonds, treasury securities, and high-yield savings instruments. Government bonds and treasury-backed securities are considered among the safest income-producing investments, especially during economic uncertainty. While bond yields fluctuate with interest rate cycles, they provide predictable income streams with significantly lower volatility compared to equities. Investors who prioritize capital preservation often use bond ladders or diversified bond ETFs to generate stable monthly income. However, bonds typically produce lower returns than stocks over long periods, which means building $10,000 monthly income purely from fixed income often requires very large capital reserves. A critical concept many people misunderstand when pursuing passive income is diversification across income sources. Relying on a single asset type increases vulnerability to market changes, economic downturns, or industry disruption. The most financially secure passive income earners in the U.S. usually combine multiple income streams. For example, they may hold dividend ETFs for stability, rental real estate for cash flow growth, digital businesses for scalability, and bonds for risk protection. This multi-source approach creates income resilience, meaning if one income stream temporarily declines, others continue supporting financial stability. Another major factor determining whether someone reaches $10,000 per month in passive income is contribution consistency. Many investors focus on return percentages while ignoring savings rate and reinvestment discipline. Consistently investing a portion of earned income into cash flow producing assets accelerates compounding dramatically. For example, investors who increase contributions during market downturns often accumulate more shares or properties at discounted prices, improving future income potential. Time in the market and reinvestment behavior often matter more than trying to perfectly time investment entries. Tax strategy also plays a major role in building passive income in the United States. Dividend income, rental income, and capital gains are taxed differently depending on account structure and asset type. Investors who use tax-advantaged retirement accounts, depreciation benefits from real estate, or long-term capital gains treatment often retain significantly more income compared to those ignoring tax efficiency. Many high passive income investors focus heavily on after-tax income rather than headline returns, because taxation directly affects how much monthly income is actually available to spend. Risk management is another essential element that determines long-term passive income success. Higher yields usually come with higher risk, and investors chasing extremely high returns often experience income instability or capital loss. Sustainable passive income portfolios balance growth and stability by combining moderate yield assets with long-term appreciation investments. This balance allows income to grow over time while reducing the probability of income collapse during economic downturns. Another important reality about reaching $10,000 per month in passive income is the timeline. For most U.S. investors, reaching this level requires years of disciplined investing, income reinvestment, and asset accumulation. While some entrepreneurs achieve faster growth through scalable businesses, most passive income portfolios are built gradually. Understanding this timeline helps investors stay consistent rather than abandoning strategies prematurely when results appear slow. Behavioral discipline ultimately determines success more than strategy selection. Many investors start passive income plans but abandon them when markets decline, business growth slows, or results take longer than expected. The investors who eventually reach significant passive income levels are usually those who maintain contributions, reinvest earnings, and adapt strategies without abandoning long-term goals. As investors move closer to building substantial passive income, one shift in thinking becomes extremely important, transitioning from working for money to owning systems that produce money. In the United States, most high passive income earners reach that level by gradually converting earned income into income-producing assets. Salaries, business profits, and side hustles become funding sources that feed dividend portfolios, rental properties, digital platforms, or bond income strategies. This transition is what separates traditional earners from asset owners. The earlier investors begin reinvesting active income into passive assets, the faster compounding begins working in their favor. Another critical factor in reaching $10,000 per month in passive income is scalability planning. Many people focus on starting income streams, but fail to design them to grow. For example, dividend portfolios grow through reinvestment and contribution increases. Real estate portfolios scale by acquiring additional properties or increasing rental efficiency. Digital businesses scale through automation, outsourcing, and expanding audience reach. Passive income is rarely built through a single breakthrough moment. It is usually built through small, consistent expansions that multiply over time. Investors who treat passive income like a long-term business strategy rather than a quick financial goal tend to reach sustainable results. Economic cycles also play a major role in passive income growth. Market downturns, housing slowdowns, or rising interest rates can temporarily reduce income or asset values. However, these periods often create the best long-term opportunities for asset accumulation. Investors who continue investing during economic uncertainty frequently acquire assets at lower valuations, which increases future income potential when markets recover. Historically, many high-income portfolios in the United States were built by investors who stayed consistent during recessions rather than waiting for perfect economic conditions. Another professional-level strategy successful passive income earners use is income reinvestment layering. Instead of spending early passive income, they reinvest it into additional assets that produce more income streams. This layered compounding accelerates growth significantly. For example, dividend income can be reinvested into more dividend-paying ETFs, rental profits can fund additional property acquisitions, and digital product revenue can be reinvested into marketing or new product development. Over time, income begins growing faster than contributions alone could achieve. It's also important to discuss sustainability. True passive income is not measured by how fast it grows, but by how long it lasts. Income streams heavily dependent on market trends, viral popularity, or unstable tenants can collapse unexpectedly. Sustainable passive income strategies focus on diversification, conservative assumptions, and maintaining emergency reserves. Many financially independent Americans prioritize income reliability over maximum return because consistency protects long-term lifestyle stability. Technology has also transformed passive income opportunities in the U.S. economy. Automation tools, investment platforms, digital distribution channels, and AI-driven marketing systems allow individuals to scale income streams faster than previous generations. However, technology also increases competition. The investors and entrepreneurs who succeed are usually those who combine automation with high-quality value creation, strong financial planning, and audience trust. Passive income in the modern economy rewards efficiency, consistency, and credibility. Another key component of reaching a $10,000 monthly passive income goal is understanding lifestyle alignment. Passive income is not only about numbers, it's about financial freedom and time flexibility. Some investors prefer real estate because it offers tangible assets and tax benefits. Others prefer dividend investing because it requires less management. Entrepreneurs often prefer digital assets because of scalability and location independence. The most successful passive income strategies are usually the ones aligned with the investor's skills, interests, and long-term vision, which increases consistency and reduces burnout. The final and often overlooked element of building high passive income is patience combined with adaptability. Financial markets, tax laws, business models, and economic environments constantly evolve. Investors who rigidly follow one strategy without adapting to new conditions often struggle long-term. At the same time, constantly chasing new trends without patience destroys compounding. The balance between staying consistent and adjusting intelligently is what defines professional wealth builders. Reaching $10,000 per month in passive income is not about luck, shortcuts, or viral strategies. It is about disciplined investing, diversified asset ownership, scalable income systems, tax efficiency, and long-term consistency. While the number may sound ambitious, thousands of financially independent Americans have reached similar income levels by following structured asset-building strategies rather than speculative shortcuts. The process requires time, effort, and financial discipline, but the reward is one of the most powerful outcomes in personal finance: the ability to generate income without relying solely on active work. Now, here's something most people don't realize. The biggest difference between people who eventually earn five-figure monthly passive income and those who never reach it is not income level, education, or starting capital. It's whether they start building income-producing assets before they feel ready. Waiting for perfect timing, perfect knowledge, or perfect market conditions often delays progress for years. Passive income is built through action combined with long-term discipline. not perfect preparation. If you want to seriously pursue financial independence, the real question isn't whether $10,000 per month in passive income is possible. It's whether you're willing to consistently build the assets that make it inevitable. And if you're interested in learning which specific passive income strategies are currently working best in today's US economy, including the exact investment structures many high-income earners are using right now, that's exactly what we'll be breaking down in the next video.